Okay, we'll get started right on time here. Hello, everybody, and welcome to our latest webinar session. This is Jim Hendricks of Hendricks Wealth and Estate Management, and this is one of a series of webinars that we host about various financial topics. And my topic today is something that hopefully is a little timely. We're going to talk about 10 financial tips as we head into 2026. And some of these will be more focused on things that you can do now, here, right at the end of 2025. And some will be more focused on heading into the future in 2026. We'll have time for questions and answers after the close of the presentation. If you do have questions, you'll see a Q&A button down at the bottom of your screen, and you can click on the Q&A button and type in your questions, and either I or somebody on my staff will be here to help us answer those questions, most likely at the end of the webinar, but we might take a break for some questions in the middle too if we have a couple of them. All right, so let's go ahead and get started. Again, today we're talking about 10 financial tips heading into 2026. I'm Jim Hendricks of Hendricks Wealth and Estate Management. I'm the owner of the firm, and I've got a couple of my staff members, Jim Madel, Tom Anderson, and Daniel Leitner here with us today. And we're going to get started by talking about just a quick thing. And this is something I've actually done for myself and saved myself several dollars going into next year. This is something pretty simple that everybody probably should do, because I'd imagine most of us at some point have probably subscribed to something that we're not using anymore. And it turns out in my own personal life, I signed up onto a music app to learn how to play guitar because my name is Jimi Hendrix. I should probably learn how to play guitar. But it turns out I did not use that app as much as I thought I might. So just a couple of weeks ago when I was creating this seminar, I went and did this for myself and canceled my subscription to the guitar app that I was not using. So on an iPhone, what you can do is go to your settings, click your name, and then click subscriptions. And then it'll show you a list of things to which you are subscribed. And I bet for most people who have an iPhone who've ever subscribed to anything on an app, there's at least one that you can get rid of and save yourself some money. There are similar ways to do this on other platforms other than just iPhones. And I'm not going to go through each of those scenarios as to how to get that done for each and every platform. But on iPhone, your order of operations is listed right there. And this doesn't just apply to things that you've subscribed to on your phone. You should be unsubscribing from anything that you're not using regularly. For a lot of people these days, that's cable television. Not that I'm not trying to hate on Comcast or any of the local cable providers, but a lot of people use streaming services so much now that the cable service is used for internet access and internet access only. So if you're paying for TV programming, you might not even realize that you're paying for TV programming through your cable bill, as well as the internet access, and then also paying for a streaming service such as YouTube TV or Hulu or anything else of that nature. So you might want to take a look and make sure you're not doubling up your costs there. That's maybe just a quick trip or a quick hint to maybe save $100 or so, or maybe even more for you as you head into 2026. All right. So other things to look at would be clubs and memberships. The people either take the end of the year, this time of year, people are either quitting their gym membership or starting their gym membership, one or the other. The people who are joining have the New Year's resolution to join. The people who've been paying for it for a couple of years that have never used it are canceling their subscription this time of year. So it's a good time to take a look at what you're doing and whether that makes sense for you as you head into next year. And then also publications. This might not be as much as it used to be, but people still do subscribe to magazines, newspapers, things like that. You should take a good hard look at what you are using versus what you're paying for to make sure that it makes sense going into the next year. Okay, now on to more financial planning related matters rather than just kind of quick tips. If you own a home, you should have at least $2,000 in cash readily available in the bank, and we don't argue with that. You know, you never know when you might need to replace a furnace or make a down payment on a claim or something of that nature that might need some cash up front. However, we do want you to optimize your emergency fund. And if you have more than $10,000 in cash sitting in the bank, we'd argue that that's maybe a little too much. Not that you shouldn't have that still as an emergency fund, but you could consider investing some of that excess, because in all likelihood, any money you've got sitting in the bank probably isn't returning that much for you. Maybe 1.5%, 2% if you're lucky. And there are ways to enhance the returns of that without taking on a whole lot of extra risk, still keeping the funds liquid and trying to squeeze a few more dollars of return out of that. For instance, if we had $10,000 that we invested and we could earn an extra 3% per year, that's an extra $300 a month, or I'm sorry, $300 a year of income that you have in your pocket just by making a simple change in how those funds are allocated. Conservative investments like bonds, bond funds, and balanced funds, which is something that we use quite a bit in our practice. We call those Goldilocks funds because they're not too hot and not too cold. Those can provide better returns for funds that aren't really expected to be spent unless you were to have an actual emergency that would be, a solid 4 or even 5 figures large, which in reality, most of us don't really ever have. And there's going to be some other things we're going to talk about even shorter term as to what you might be able to do with some of those short-term funds to maximize your tax efficiency for this year and next year, and also some other tips and tricks to do with your shorter-term cash, and that'll be just a couple slides ahead. So going on to number 8, we're doing this in countdown fashion. So number 10 was to look at your subscriptions. Number 9 was to optimize your emergency fund. Number 8 is to conduct a life insurance review. And one thing to look at here, to ask yourself when it comes to life insurance, is there another human being that relies upon your income? And if you answered yes to that, then you probably need to have life insurance. Another thing you could ask yourself, am I relying on somebody else's income? And if you say yes to that question, then that somebody else should have life insurance on themselves. Not to get into sob stories, but in my past, my families that I grew up with on 2 separate occasions needed life insurance, and one time they had it and one time they didn't. So lost my dad in an accident at work when I was 10 years old, and we were not adequately insured at that point. And then my mom remarried, and we lost my stepdad in a car accident when I was 20 years old, and that time we did have life insurance. So when you lose a family member, it's hard enough already without the financial constraints that can come along with that, and life insurance can help ease the financial part of all of that heartache that you're going through anyway, as long as you're adequately insured. Nice thing is that term life insurance is not all that expensive. A lot of people are offered insurance through their employer, and that's good, but it's usually not enough, at least not at its base level. And also, one thing about employer insurance is that's only good as long as your job is good. So if you're terminated for any reason, whether you terminate yourself by saying I'm moving on to a different job, or if your employer terminates you, then that's the end of your insurance to that employer. And people don't always think about that when they're changing jobs. And again, usually your base coverage is not enough anyway. Usually you just get 1 or 2 times your earnings as your base life insurance. And for most people, that's just simply not enough insurance. People might say, well, that's going to be enough for me for now. But the problem with having employer insurance, if you're going to buy yourself into enough coverage, it's relatively cheap now, but every year you go by, it gets more and more and more expensive. And generally, it will be long-term cheaper for you to buy a term policy today than to keep paying those annual increases on those annually renewable policies that you'd be getting from your employer. So we generally recommend people own term life insurance because that's the best way to provide adequate, low-cost insurance for you and your loved ones if something were to happen to you. Now, it's impossible to tell everybody in this presentation how much life insurance they should have. But if you're looking for a rule of thumb, a good rule of thumb is 10 times your income. If you're wondering what amount is right for me, you could always call our office and we can help you determine what amount you should have for you. But again, a good rule of thumb, particularly people in their 20s, 30s, and 40s, is generally about 10 times your income is how much life insurance you should have on your own life. Okay, and then the idea is, the reason we want you to have term life insurance is if I could rename life insurance, I would call it income replacement insurance in case you pass away while somebody else is relying on your income. Now, that's a really long name, so they don't call it that. They call it life insurance. But that name life insurance implies that you need it for your whole life. But you really shouldn't need life insurance for your whole life. You only need it for that period of time where somebody else is relying on your income. When it comes time to retire, you're making a deal with yourself saying, I've put away enough money now, I don't need any more money in order to be able to support my own lifestyle. So therefore, nobody's really reliant upon your income anymore because you don't have any income anymore. So at that point, once you reach retirement age, generally the need for life insurance goes way, 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 way down, if not completely away. And again, that's why term life insurance is the best. It's the lowest cost variety of insurance. People who sell it don't make all that much money selling it. So if somebody's trying to sell you life insurance, they might very well be telling you that you need a whole life insurance policy or something with it that carries a cash value. But I'm here to say that for most people, term life insurance, the inexpensive, low commission version for people who sell it, is the way for most people to go. All right, going on to number 7. We're going to have you assess your debts. Um, this one's kind of a no-brainer. If you have credit card debt, plan to pay it off in 2 years or less. That's something I've said for my whole career. I know that if you have a heavy burden on your credit card debt, it might take you a while to pay it off. If you're on pace to have it take you more than 2 years to pay it off, my recommendation is that you make some type of major lifestyle change so that you can get rid of that debt in less than 2 years. That major life change might be getting a second job. It might be moving in with your parents. It might be going down from a 2-car household down to a 1-car household to cut your car payments in half. Something drastic in order to be able to get yourself to be able to get rid of that credit card debt within 2 years, because we all need to be in a position where we're building assets, not paying off debts for our long-term finances. And when we're talking about paying off debts, we're not necessarily talking about mortgages. Specifically, in this instance, I'm talking about credit card debt. Credit card debt comes at a very, very, very high interest rate, oftentimes higher than 20%. And there's not an investment in the world that I can show you where our expected rate of return is 20% or higher, no matter what anybody tells you. It's unrealistic to expect any type of return that comes close to the average interest rate on credit cards. So there's nothing that is worse than having credit card debt, generally speaking, for a long-term financial plan. So there's 2 strategies we can use to try to pay it off. One is the snowball method, where you just take, if you have multiple cards, you take the one with the smallest balance and you focus on paying that one off first. And then you get to, raise the flag, say, hey, I got one down, and then you go on to the next one, and then the next smallest one, and then the next smallest one, until you eventually you're working on the largest one. And that way you feel these small victories as you're going along. If you need that for motivation, that's fine. If you're looking to save yourself the most money and do it in the most financially beneficial way, then you'll want to take a look at all of your debts and look at the highest interest rate one and focus on paying that one off first. So if you've got 2 cards, one's at 27%, one's at 22%, let's pay down that 27% one first and work like crazy to get that one paid off, and then we start working on the 22% one the second. Notice I'm focusing on credit card debts when I talk about this. We're not really talking about student debt. Student debt is generally at a manageable interest rate. And for a lot of people, it might be better to put money into your 401k through work than it is to pay off a student loan or certainly a mortgage these days. Mortgages generally are at lower rates than, say, 8%. And that's kind of where I draw the line. Any debt at an interest rate higher than 8% probably should be eliminated. Anything less than 8%, there's a real good chance that you might be financially better off in the long run investing those dollars instead of using them to pay off a debt that's lower than 8%. So usually in our office, we're not really ringing the bell too loudly for people to make accelerated payments on their mortgage, because a lot of people these days, or a lot of our clients who have mortgages, those mortgage rates might be anywhere from 3%, or in some cases even lower than that, in the high 2s, up to about 6.5% these days. So depends on when you got your mortgage. If you got it 8 or 10 years ago, you could be down in the low single digits. And if you got it over the last few years, you might be in the 6.5, or even 7% range. But no matter where you are, that's still lower than the long-term historical average rate of return of something like the stock market. So if you have an option to invest your dollars into an investment that has a good chance of outperforming the rate of interest that you're paying on your asset, like your home, like your mortgage, then we want you to take your time paying off that mortgage and instead take those excess dollars and add them into your retirement portfolio or your investment portfolio, even if not a retirement portfolio. So anyway, again, any interest rate higher than 8% should be eliminated. And generally, we feel like student debt and home mortgage debt is okay, provided you can afford it, provided you haven't bitten off more than you can chew with those dollar amounts of that debt. All right. On to number 6, maximize tax-advantaged contributions. So if you're looking for a tax break and you haven't maxed out your 401k, then that's probably the lowest hanging fruit. Here we are at the end of the year. It's December 10th, I believe, today, and we've only got 20 days left in the year. And you might say, well, I don't have much time left to add to my 401k. There's a little trick you might be able to use. Just for the rest of the year, like right now, you could go to your HR department today and say, take 100% of my pay for the rest of the year and add it to my 401k. So let's say you're making $96,000 a year. That'll make the math relatively easy. That's $8,000 a month. If you've got one paycheck left, that'll be $4,000 that you're going to have left. And that $4,000 could go into your 401k, and that'll lower your taxable income by $4,000. That's a tax deductible contribution that you make to your 401k. When you say, okay, well, then I've got no money on my paycheck. Well, if you've got savings, remember earlier I said I'd allude to a trick you can do if you had $10,000 in savings. If you've got $10,000 in savings, you can temporarily spend that $4,000 that would have been on your paycheck and live off of 4,000 of those dollars for the rest of this year. And now you've lowered your taxable income by $4,000. You've got the money that you've lived off of. You've made your savings account more efficient. And then if you do need to build that savings up, you've always got next year that you can do that, but you're getting a little bit less tax now this year while you can. All right. Then you could always also take savings and add them to a traditional or Roth IRA if eligible. So you've got until April 15th of next year to do that. So if you haven't made your traditional IRA or Roth IRA contribution yet for this year, then you do have a little bit of time yet. So you could just take some of your savings as time goes by that was maybe going into a savings account and funnel those into your Roth IRA or traditional IRA. And there is a little bit of secret that not everybody knows. If you have your emergency savings, you say, well, I don't want to use my emergency savings to go into my Roth IRA. There is a little trick. You are allowed to use the principal contributed to a Roth IRA free of tax and free of penalty. So in other words, you could make a contribution to your Roth IRA, then all of a sudden, whoops, an emergency comes along that you didn't expect, and you used your emergency fund to fund your Roth IRA. Well, you can take that money out of your Roth IRA without penalty, ever. So your principal can always come out of your Roth IRA without any penalties. Now, if you think there's a realistic chance that might happen, then I'd rather have you not make that contribution, because we don't want to be in the habit of putting money in and taking money out and putting money in and taking money out. But for a true emergency, if it's a matter of being able to make the contribution or not, and if it's going to happen, it's going to have to happen out of your emergency fund for this one time. I think it's, we say it's okay if you're in a pickle and it's either make the contribution or don't. Go ahead and use your emergency fund, because you could always take it out if you need to, if there really were a true emergency. All right, let's go on to number 5. Consider a Roth conversion. So a Roth conversion is when you take money from a traditional IRA and convert it over to a Roth IRA. And that is a taxable transaction. So if you have, let's say, $100,000 and you convert $100,000 from your traditional IRA over to your Roth IRA, then you are recognizing $100,000 of taxable income in that year. So when is it a good time to think about doing this? It's a good time to do it if your income is relatively low and it's likely to be higher in future years. So you might be in the 12% tax bracket now, but you're going to be in the 22% bracket in the future. And when you retire, you're going to feel like you're going to be in the 22% bracket. Well, why not fill up that 12% bracket right now up to the top by converting up to the ceiling of that 12% bracket, which for married couples is just under $100,000 of taxable income? Why not fill up that 12% bracket, pay the tax, and then you've lowered the effective tax rate that you'll pay on that money forever. You might pay 12% tax on it now, but by converting it to the Roth, you won't ever pay tax on it again. It'll grow tax-free forever, and you saved yourself paying 22% tax on that later in life. So that can be a good strategy. Good rule of thumb when using this strategy is to convert enough so that your income will be near, but not over, the top of the marginal tax bracket that you plan to have in retirement. So if you know what kind of income it's looking like you'll have in retirement, if it's higher than what you've got today, then that is a good year to potentially do a Roth conversion. So again, it's good for people having an unusually low amount of income in the current tax year. And doing a Roth conversion can also, for those people who are closer to retirement, Let's say you've retired, your income is lower now than it was during your working years, but you've got an IRA with a lot of money in it. Someday, once you turn 73, you're going to have to take required distributions from that IRA, and that might force you into a higher tax bracket. So if you can convert some of your traditional IRA to a Roth IRA today, you can recognize some of that income now at lower tax rates and then lower the amount that you're going to have to take through the process called required minimum distributions, or RMDs, out of your IRAs by the time you reach age 73. The IRS does not want us deferring tax forever, unfortunately, out of our IRAs. So they make you start taking distributions once you're 73 years old. They start at roughly 4% of your balance, and then that goes up every year from that point forward by about 0.3% on average. So on a $100,000 traditional IRA, you're expected to take $4,000 out of that. But if you've got a large balance in your traditional IRA, say, $1 million, you could be looking at being forced to take out $40,000 a year taxable out of that IRA each year. And if that's going to bump you into a higher tax bracket, then maybe think about taking some of that and converting it earlier after you've retired, but before you're 73, so that you can smooth out that tax bill a little bit and make it a little more tax efficient. All right. On to number 4, make charitable contributions. We've done some other seminars on this topic, but it's still a good idea to do something called bunching. In fact, 2025 is a really good year to do this. We're starting to run out of time, but there still is time. Bunching is a process that you take your charitable contribution and you make all of your charitable contributions in one year rather than spreading them out over a number of years. Let's say that you've got $40,000 sitting in an account right now, and your normal plan is to donate 20,000 of that this year and 20,000 of that next year. Well, it might be better off for you to donate all 40,000 of that this year and none of it next year. And the reason for that is married couples get a deduction of $30,000, our standard deduction of $30,000 off of our income in 2025. In order to be able to get a deduction on your taxes for any charitable contributions you make, you have to give more than your standard deduction, and that's called itemizing. So if you're itemizing, your itemized deductions, which includes charitable contributions, state and local taxes, and various other types of deductions, when pooled together, if they're more than your standard deduction, you get to deduct those. So if you're donating $20,000 in one year, and that's the only itemized deduction you've got, you're not exceeding your $30,000 standard deduction. So therefore, you're not really getting a deduction on your taxes for that charitable contribution that you've made. Instead, if you gave $40,000 this year, that would qualify you for an itemized deduction. So you'd get a $40,000 deduction this year. And then next year, when you donate nothing, you're still going to get your standard deduction of $30,000. So those two together would be $70,000. Excuse me. Whereas if you give $20,000 each year, you're not itemizing either year, and your cumulative deductions between your standard and itemized would only be $60,000, $30,000 each year between those 2 years. So overall, again, you can increase your deductions by doing this bunching strategy, and you can do it without even giving the money to the charity. I know that sounds a little crazy, but there's this tool called a donor advised fund, or we call them DAFs. And with a donor advised fund, excuse me, you can add your money to an account right now today that's designated as a donor advised fund. You get the deduction today. The money can be invested to grow for a future year, and then at any point in the future, there's no rules as to how much you do or when you do it. At any point in the future, you can instruct those dollars to go to charities, but those dollars do eventually have to go to charities. Once they go into the donor advised fund, you can't take them back. They do have to go to charities. But again, that's a way to get your deduction now. Let's say you wanted to get a deduction, but you're giving money to your church, and you don't want to give your church a big, huge lump sum all at once. You want to spread it out over time. You can still get the deduction now by adding that money to a donor advised fund and then spreading those actual contributions from the donor advised fund to the church over a number of years. All right, so it gets pretty complex, and we're happy to talk to people about this, but the strategy itself is fairly simple. There's a little side note here. Beginning in 2026, donations are going to be subject to a 0.5% AGI floor, meaning that they take your adjusted gross income which is factored based upon your gross income. So basically take something close to your income, multiply it by 1/2 of 1%, and they're going to basically disallow the first that amount from your charitable deduction. So if you make $100,000 in adjusted gross income, you take 0.5% of that, which is $500. Your first $500 that you donate to charity will not be deductible in 2026. So 2025 is a better year to make charitable contributions because the whole thing is deductible here in 2025. And then we don't want to get too complex here, but for those of us who are subject to required minimum distributions, if you're age 73 and a half and over, I say us, I'm not in that club yet. But for those of you who are age 73 or older, you might be required to take distributions from your IRAs. You can make that tax deductible whether or not it's above that $30,000 threshold to itemize. You can still make those contributions deductible by doing something called a QCD, which is a qualified charitable distribution. If the money goes straight from your IRA to the charity, then you can deduct that contribution on your taxes, again, whether or not you did qualify for itemized deductions by going above that standard deduction threshold. So basically, you're going to get some bang for your buck on your tax return if you donate those funds via a QCD directly from your IRA to the charity. But you do have to have subject to RMDs in order for that to happen. There is a little side rule there. Technically, you can do it starting at age 70 and a half, even if your RMDs haven't started until age 73. All right. Number 3, this one doesn't apply so much this year, at least not for many people that we know, thankfully. But there's something called tax loss harvesting. Let's say you have an investment that's gone bad. You can sell that investment, recognize the loss, put that money into something similar if you want to, just not the same thing, keep it invested, and recognize that loss for your tax return this year. That can be used to offset any capital gains you might have this year. There are a lot of capital gains, generally speaking, throughout the markets this year. So if you have losses on any type of investment, then you could sell that investment, buy something similar, and use those losses to offset any gains. And it can even offset up to $3,000 of your ordinary income. Not only that, but if you have more than $3,000 of net losses when netted against your capital gains, any unused amount of that capital loss can be carried forward into the future and used against future capital gains, and even $3,000 per year of ordinary income. So you can lower your taxable income every year by simply selling an investment that is held at a loss right now. I know we don't necessarily want to sell investments at losses, but if you've got a lost cause out there, there is an advantage to selling it rather than just letting it sit in a worthless state. So if you want specific advice about those types of investments, that's a good excuse to call a firm like ours to help you with that, to see if that's in your best interest to do that. But generally speaking, tax loss harvesting is something that we've used periodically in our practice, especially during down years on the markets. Number 2, estate planning review. So this is something that everybody should think about. You might think, well, I don't have an estate because I don't have enough money. Yes, you do. Everybody has an estate. And everybody should consider having the basic estate planning documents, which includes a will, a healthcare directive, a financial power of attorney or advance directive, and a trust. Trusts might not apply to everybody, but the first 3 things do. Will tends to get all the PR, and in my opinion, a will is not the most important estate planning document. Eventually, a trust should be your most important estate planning document, but it's still important to have all 4 of these documents nonetheless. If you don't have them, talk to somebody, talk to a financial planner, talk to us, talk to your attorney. You might want to talk to a financial planner before an attorney because they're a little cheaper. Financial planners cannot do these documents for you, but they can point you in the right direction to get them done. And then you want to review who you've got listed as your executor and or trustees. Review who your beneficiaries are, and this is a really important one for our practice these days. You want to think about the tax implications of those beneficiaries. It gets a little complex again, but generally speaking, if you've got 2 beneficiaries, 2 kids, one makes a lot of money, one doesn't make a lot of money. The example we like to use is one's a rocket scientist, one's a dog walker. Both of those are good professions, but rocket scientists tend to make a little more money. If you have a taxable IRA and a non-taxable investment account, you might be better off leaving your taxable IRA to the lower income child and the non-taxable investment account to the higher income child to make the whole settlement of your estate more efficient. And we commonly see a 2, 3, 4% difference in the value of estates from a tax perspective when we're doing these analyses for clients. So 2%, $2 out of every 100 that you've ever made and saved could be avoided in taxes just by doing these simple exercises. But it usually takes a professional to help you out to make you make these decisions in the most efficient way possible. And then the number one is kind of a good segue into that, and that is to perform an overall financial checkup and to have a professional review your plan in its entirety so that we can help you, or somebody can help you prioritize, organize, and plan not only your financial future, but everything you've got going on right now as well. And that can benefit you, your beneficiaries, and even generations down the line, potentially, in some cases. And financial planning is not just about having a diversified portfolio. It is about making sure that you're making wise decisions with as many aspects of your financial life as possible. It's not really just picking investments. A lot of times people kind of pigeonhole us in our profession as just being investment managers. And in our opinion, we are so much more than that. It's about making just wise decisions in all aspects of our financial lives, and a good financial planner will help you with buy lease decisions, whether you should pay off your mortgage, all the things we've talked about during this meeting here, during these 10 points. We can help with all of those, and a lot of times it's just good to have an extra sounding board to go to with those things, and it can add a lot of efficiency to your overall estate plan. And I don't think anybody's hurt by having a free consultation with a financial planner. And to that end, with our firm, our initial consultations are always free. And one of our taglines is, if you spend an hour with us, we want we want you to come away from that hour feeling like you've just spent the best hour you've ever spent on your personal finances. So I've gone about a minute and a half over here. I appreciate the time that you've spent with us today. We do have some more webinars coming up. We don't have the topics quite picked out yet, but we are going to be taking the 2 weeks of the holidays off, so no webinar on December 24th or December 31st. We do these every Wednesday at 11:30 Central, 12:30 Eastern. But again, nothing on Christmas Eve or New Year's Eve. Next week, though, my brother, Sean, will be on, and he will be talking about the power of gifting. We touched on that a little bit today, but he'll be going into that a little deeper. And then next year, during January, we have, in this order, we have Daniel Leitner, who's with us here today, Tom Anderson, who's also here with us today. I'll be back on January 21st, and then Jim Madel, who's also here today, will have the show on January 28th. That's about it for me today. I don't see that there's any questions. If you do have questions, I'm willing to hang out here and answer them as best I can. So if you have questions, please type them in. Again, I have not seen any pop up during the presentation here, but if you have them, now is a good time to type them in. You can always feel free to call our office too. Our phone number's on your screen. It's 847-428-3997. We do have offices in Bradenton, Florida, and in Algonquin, Illinois. I speak to you today from Bradenton, Florida. Tom is also in Bradenton, Florida. Jim and Dan today are in Illinois. So, and we're ready to help you in both places. We have clients all across the country, though, so we can help you no matter where you are. And you can learn more about our firm by visiting us at hendrickswealth.com. You can email us at our general inbox at info@hendrickswealth.com. We are also on social media. You can find us, Hendricks Wealth, on Facebook, and we're also available on LinkedIn too. If you look up Hendricks Wealth on LinkedIn, we're there as well. Thanks again for attending. Again, there still are no questions that have popped up. So again, we can be reached in Illinois at 847-428-3997, in Florida at 941-308-9862. Okay, thanks everybody for attending, and we'll hopefully see you at another one of our presentations in the near future. Happy holidays, everybody. Bye-bye.
Take care.